Thank you everyone for joining us this morning. We have Tom Williams on from Downing, who's going to give us an update on the recent first half results and key results from Downing Renewables and Infrastructure, and to just run you through why Downing think that now's a good time to be looking to raise some capital to pick up some of the assets in their pipeline. You will have seen an announcement came out 29th of September announcing that they were intending to raise up to £25 million, and that offer period is currently open. So I'm going to pass over to Nick to talk about what's going on with Downing Renewables Infrastructure and to explain why exactly now is a good time to pick up some of these pipeline assets. So over to you, Nick. Thanks very much.
Right, thanks very much. Just flicking through now to these are the important notices. So apologies if there's a few of them, but they are worth talking about. There's a summary here for everyone to just have a read through once we finish the presentation. But first of all, I just really wanted to give you an update on where we are today. So if you recall, when we talked about launching the vehicle, which we had, and the IPO was in December last year, we talked about investing the proceeds of the IPO over the course of a year. In fact, we're currently 83% invested. In fact, we were 83% invested after 4 months. The assets that we have invested the fund in have done better than we have expected. So we were with 6% up on generation, we're up on operating profits, and that has allowed us to experience the NAV growth that we've experienced, and also pay a 1p dividend for the period to the end of June, and also bring forward the dividend guidance, which is now 5p per share from January next year, when we thought we would be able to start to pay that dividend, to July this year, July 21. So we've managed to bring forward the dividend guidance by 6 months. The reason that we're here talking today is we are raising further capital for the vehicle. Why are we doing that? We're doing that because we have a very significant pipeline of opportunities, about 4.3 billion in various different sectors, in various different target geographies. That's a very big number. We won't be investing anywhere near that, of course. We have a fraction of that left in cash, and a fraction of that seeking to be raised as a part of this. But we did want to just share the breadth of the opportunities and tell you how excited we are about what we might be able to do in the future with the fund. So a quick reminder just on Downing. We have quite some experience in the space. We've invested for about 11 years now in core renewables. We've done 133 transactions. We've delivered a very healthy IRR in both the assets that we've subsequently exited and also those we're holding on to. And we have about 180 people, 30 or so of which focus on energy and infrastructure. We do take investing responsibly very seriously. We are an Article 9 SFDR fund. What that means is that that is a fund which has a specific investment objective that's related to sustainability. And we'll talk a little bit more about that later on. A reminder on the strategy of the vehicle. So it's all about diversification. It's all about embracing that diversification at the heart of the strategy. We think that has two main benefits. The main benefits are an increased ability of returns and a broadening of the pipeline of the opportunities. We talked about just the considerable size of the pipeline at present. We just talk a little bit about why we think diversification does increase stability of returns. If you think about what we invest in projects which are reliant on a natural resource. If you just invest in one technology, you are reliant on one natural resource. That natural resource is variable and intermittent, and therefore what we try and do is invest in more technologies and reduce your reliance on any given natural resource. When you move geographies, you can access different natural resources, like the hydro assets that we own in the Nordic regions. And if you invest in the same technology in different geographies, you can achieve diversification because it doesn't always rain at the same time in Stockholm as it does in Surrey. When you invest in a different geography and a different energy market, you can achieve diversification because you're selling your units of energy into markets with different fundamental drivers. And again, that's very much the case with the Nordics and the UK, and we'll talk a little bit more about that later. When you combine that diversification by technology, geography, and project stage, you reach diversification by revenue stream. And we have a particular focus, and again, we'll talk about that later, on that merchant power price exposure. What are we seeking to do in our fundraise? We're seeking to raise around about £25 million. We are going to apply that to acquire assets within the pipeline. We hope we have 4 near-term opportunities that total just under £90 million. Those are wind projects, hydropower projects, some in Sweden, some in Finland. The key date is the 13th of October, that's this Wednesday, when we'll be closing the offering. And we'll announce the results on the 14th, and we've got some more details here on just the issue price, which is obviously at a discount to the day immediately before we launched, and a premium to the NAV. Just to give you a little bit of information about the portfolio as it stands today, we've got operational hydropower plants in Sweden and operational solar parks in the UK. So looking at the hydro a little bit more, there are 8 hydropower plants. They're located on 3 main river systems in Sweden, 2 price zones. The reason why that's important is because Sweden's broken into 4 price zones, and each one has slightly different pricing because there are constraints for the electricity to pass between each of the different price zones. And these assets have a very long operating track record. They've been operating for between 60 and 80 years. We firmly believe that they will be operating for another 60 to 80 years. And now that we have a portfolio of scale, we're able to make very attractive bolt-on acquisitions. And in fact, some of the 2 of the opportunities that we have in our pipeline, our near-term pipeline, that we actually have exclusivity on, are little bolt-on acquisitions that will increase the size of the portfolio by about 1/3, and they are accretive to the returns that we're already achieving in the portfolio. On the UK solar side, great set of assets, about nearly 50 companies, 3,000 assets, operating for 6 to 7 years. They benefit from high degrees of fixed revenues. They have significant subsidies, and they also then have a number of fixed revenue mechanisms on top of the subsidies in the arrangements pursuant to which they sell the energy into the market. Provides you with very significant downside protection. This is what the portfolio looks like today. So you've got technology on the left-hand side there. You can see the split between the hydro and the solar. And you can see in the middle the power market. So we sell into 3 main power markets at the moment: the Swedish market, the GB market, and the single electricity market, the Northern Irish and a unified Irish market. The portfolio at the moment fully operational. Quite a lot of focus at the moment about power prices, and particularly exposure to merchant power prices. Now, we consider this to be one of the biggest risks in these kinds of funds and vehicles. And so what we try and do is give you a really good idea about where we stand. So that is calendar year 2021. At the moment, you can see that we've fixed most of the power prices that we're selling our electricity at. And there's a small portion there left, which is that grey bar at the top left-hand corner. On the right-hand side, you've got a year, 10 years in advance. So you can see that even 10 years out, we have very significant amount of fixed revenues, more than half. And we do have more merchant power than today. Why is that? It's because what we tend to do is, as the revenues come closer and closer to us in time, we tend to fix them. So we about 5-year rolling in the Nordic regions, and about 3 years or so in the UK. We progressively fix more and more and more until once we're in the year, hopefully they will look something like the 2021 numbers there. We did talk about sustainability, about having a specific sustainability investment objective. So we've got some statistics here for you. These are very similar metrics to what other people produce, so you'll be able to see and compare how we're doing against others. That's the idea. Also, usual things here about the number of power homes that we power, the tons of CO2 that we avoid, but also some other things around the environmental management. We do take the stewardship of the waterways and the land that we own or manage quite seriously, and then also some statistics about the community funding that we have and the community programs that we have in place. So we do a number of different programs with schools and for instance to bring them around a number of our power plants. We have an initiative at the moment to take a few thousand children around various different sites around the country, and health and safety, which we do take, of course, very seriously. So having touched on that a bit, we'll touch about the financial performance, which is another one of the objectives that we have in the business. And in short, the fund is going really well. So you can see those 2 green bars in the middle there, performance that is over and above what we expect. So that is a real positive in the performance of the vehicle. And we have also benefited from those movements in those future power prices, which on our projections then create value today. As we said, partially due to the speed with which we've invested, partially due to the performance of the assets that we've invested in, we've been able to pay that 1p dividend, which we paid on 30 September, and we've been able to increase that dividend going forward. If we look at how that breaks down then for the different asset classes, we have the Downing Hydro here. That is a very similar story. So you can see the performance here. That is just simple, more units of energy generated, sold for higher prices than we expected, and that has created additional value over and above what we expected. And then the power curve section there, that's just saying that again, the outlook for the power prices in the region has increased since we acquired the business. Small note here is that we have actually managed to capture some of that in our hedging program, so we will now expect to see that come through. Very similar story on the solar here, and generation still above, just broadly in line, a little bit above. Operating profit a fair bit more. Again, that's because we had slightly better pricing and a bit better cost control than we assumed. What we have here, again, to allow people to compare us against others, is we've published a range of sensitivities to give people an idea for the risk within the portfolio. The thing that I draw your attention to here is the discount rates. We've got a range. So the weighted average is 7.3, but which I think compares favorably across the peers. But we have a range of 5.5 to 7.5, so that's bookended. The solar is both ends of that. Unlevered solar is 5.5, levered solar is 7.5, and the hydro is just a touch over 7 to give you that 7.3 average. In addition to raising further capital, we are also undertaking a number of initiatives within the portfolio to improve the capital structure, release some more cash to invest. The two main initiatives for that are the hydro assets. We acquired the hydro assets unlevered. We've now agreed terms on a debt facility to allow us to fund some further acquisitions in the hydro sector, and also to fund a little bit of the capex going forward. I expect to sign that over the course of the next few months. And the revolving credit facility, again, that is a facility at the fund level that will allow us to buy assets in advance of coming back to the market to raise capital. Again, very similar to our peers, that'll be roughly about 25 million or so. Overall, the borrowing at the moment, a touch over 30%. So this is the rationale for the fundraising. As you can see here, the pipeline is considerable. Now, it's to a certain extent, this is great, but not hugely meaningful. We're not going to be able to do, we're only going to be able to do a fraction of what is out there. But what we're trying to show you is that the strategy of looking at different technologies in different markets does allow us to access a lot of opportunities. And there are a lot of opportunities out there, as you can see. Here you have a small subsection of that pipeline. These are 4 opportunities that we've highlighted for you. 2 hydro power plants. We're actually exclusive on both of these portfolios and are undertaking due diligence on them at the moment. They are both complementary to the existing portfolio that we have. First is 11 run-of-river hydropower plants. Again, reservoir capacity. Why do we like reservoir capacity? We like reservoir capacity because it is effectively a really, really, really big battery. And why do we like batteries? We like batteries because it allows us to be able to produce the energy more when we want to produce the energy and try and capture some of that higher pricing. And in some cases, in our existing portfolio, those reservoirs are so large that we can actually move production not just by across days or weeks or months, but actually in one case, from one year to another. On the right-hand side here, you can see the second hydro portfolio. Again, similar areas, so SE3 price zone. It's a slightly smaller portfolio than the other one, but together they're about 34 gigawatt hours. Like I said, about a third of the size of the portfolio we already own, which is about 108 gigawatt hours. On the bottom, we have a wind project. We're keen to introduce wind into the portfolio to further diversify. This one's interesting. It's currently being built. It's a nice size project. We'd be acquiring it once it has been built and started operations, which is scheduled for the Q2 next year. And the strategy would be for that long-term PPA to be in place prior to acquisition. So again, with a focus on this merchant power price exposure. The second project is actually this one here. So you might be familiar with this project. This is something we've been working on for a while. It's under development at the moment. So we're just working with the developer to try and get that to a place where we can invest in it, which will be when it's ready to build. It's going through procurement at the moment. And it's a nearshore wind farm in Sweden's largest lake, Lake Vänern. This project is something a little bit different. We've put it up here because we again think this is something that makes us different, an ability to invest in utilities and electricity grids. Why do we like electricity grids? We like electricity grids because of 2 reasons. One is they're perpetual assets as well, so they'll last a very, very long time. Second of all is that they do not sell electricity. They transport electricity, and they get paid for making the wires available. They don't have exposure to market power prices. And so very good way of reducing your market power price exposure is by investing in an asset that doesn't have any. This particular asset, nice size, 25 million plus, combination of an electricity distribution grid and some hydro assets. We're still talking to the vendor on this particular asset, whether it's this one or one like it. These are exactly the kind of assets that we'd like to have as a decent chunk of the portfolio. We can do up to about 25% of the fund in these kinds of opportunities. So if I just think about then where we are today and try and summarize it for you, we've invested 83% of the fund more quickly than we thought we would. the assets have performed better than we thought they would. That has enabled us to experience NAV growth. It's enabled us to pay cash dividend and bring that dividend guidance forward. We are talking to you today because we do have a very significant pipeline of opportunities, well in excess of any cash that we have available in the fund, and we'd really like to raise some further capital to invest in it. So really, that was it from me. These are the key dates here. That key date being that 13 October, which is the fundraising close. That's on Wednesday, and I'd be delighted to take any questions that we have from here.
Thanks very much, Tom. There's a couple of questions come in so far. The first one, an interesting question on the pipeline. You're targeting 25 million. Did you not consider raising more money for that raise, given the pipeline, or is this specifically related to the targeted 4 pipeline assets you're focusing on at the moment?
Yeah, so there's 2 aspects to that, and it is a question we get actually a fair bit. So it is a good question. The first is that there's a sort of technical one, which is that when we launched the IPO, we had in it an ability to raise another 20%. Already baked into our shareholder approvals, so we didn't need to publish a new prospectus, which is a kind of lengthy and costly process. So that was an attractive option for us. Mm-hmm. Second of all, we've just brought the dividend forward by 6 months to that 5%, 5p run rate. It was important to us to make sure that what we did, on the capital raising, we didn't want to jeopardize that. So we wanted to make sure that people who had invested with us were provided with the dividend that we've targeted for people. And third of all, we do have still a little bit of cash left over. We have the RCF that we're putting in place, and we've got some ability to refinance the hydro assets, all of which generate cash to invest. And so we felt that this would keep us ticking over until into next year, and then the fund will be a bit bigger, and then maybe we'll do something else once we've spent this capital. Okay,
thank you. Yeah. Next question. Can you elaborate a bit on the strategies to secure long-term PPAs? How easy or common is it? What are the differences to hedging?
Yeah, so PPA markets are different according to the different jurisdiction. So in the Nordics, for example, this is a relatively well-trodden route. There are quite a few PPAs available. They generally tend to vary in duration between 5 and 15 years. We have a preference for going as long as we can. Typically, you do pay some value away for that, so you end up with a sort of a compromise between value and that you're paying away and the value that you attribute to having fixed revenues and not being exposed to merchant power price. So generally we tend to come out around about 10 years or so at the moment in the Nordics. The kind of people that do this are people who are significant users of power in the region. So they tend to be a whole range of people, actually, from large corporates, even some multinational tech companies who have data centers, for instance, that use a lot of power in the region, all the way through to local industry, and even then actually some oil and gas majors, actually, fun enough, who are trying to secure renewable energy supply to offset some of their other activities. So it's a whole range of people. It is easier to get in the Nordic regions than it is in the UK. There's a less developed market for this in the UK, but it is growing, and we'll see, I think, more and more of those arrangements in the UK as we go forward.
Okay, thank you. Got one come through on email. What are the diversification benefits of being invested in the Nordics?
Yeah, so I think if you go back to what I was saying about diversification on one of the early slides, we talked about strategy. If you invest in these different technologies, the times that they produce are not correlated to one another. So, and if they're not correlated, that means that you generally will have a stronger, more stable generation profile and thus yield profile. And so that's the principal benefit. After that, you then have this idea of the out-term price. So if you're investing in the UK at the moment, what's in the news is the fact that the UK's power prices are driven by gas and carbon pricing. And that's, at the moment, we're concerned about levels of supply of gas. That gas has become more expensive and everyone's bills are getting more expensive. So gas and carbon drive the price of power in the UK. In the Nordics, you don't see that dynamic as much. Because in the Nordics, just a touch over 50% of the Nordic region's electricity generation is from hydro. And in Norway, it's as much as 95%. So it's a very different dynamic. It's a very different set of pricing, and they move in different ways over time. And if you have a portfolio that is producing energy at different times of the day, different times of the month, different times of the year, what you want is to be able to capture those different out-term pricings in the market as well. And the more that you do that, the more diversified you are, the more consistent your revenues, consistent your yield will be. I see there's another question here as well, actually, about
yes. I was just going to pick that one up.
Yeah, about opportunities outside Europe. We do see a lot of opportunities outside Europe. I think for the time being, we like the focus of this vehicle being that UK and Northern Europe specifically. For some of the reasons that I've just been talking about the different markets, but also the fact that we see there are plenty of opportunities in the target markets that we're looking at that fit our size, the check that we can write, and also the returns and yield that we're looking for. So whilst that is still the case, I think we're very happy sticking with the strategy and with the geographic focus that we have. We're also actually increasing our presence. So we actually opened an office in Sweden this year. We've got a few staff there who are looking after the assets for us, focused on hydro and on wind. And so what we're trying to do is build up that presence, build up that expertise, and access more and better deals, and then look after those assets more intelligently, more robustly, more efficiently. And so that's why we're continuing to focus on that Nordic and the Northern European side of things.
And a question here, and the differences between inshore shallow wind farms in Sweden and against offshore wind farms. Are the economics substantially different between the types of wind farm?
Yeah, I think generally nearshore wind farms, you're talking sort of around about 12 meters of water. So it is just easier. Everything's just, the scale is slightly smaller, and so it is cheaper, it's easier. It's not as advanced engineering as it is when you're really going out into sort of deeper water in the offshore wind farms. And of course, your supply chain, because you're on land, you can take it to the edge of the water. You don't. There's a lot less requirement for specialist vessels and those sorts of things. So just overall, it's more straightforward.
Okay. A question on the IPO proceeds. They were deployed quite quickly. Do you envisage that you'll be able to do the same with this capital raise?
Yes.
Simple question. Simple answer. There we go. Yes, absolutely.
Yeah, I think we'll. I'd really hope that we'd be able to invest the capital fairly quickly. Like I said, we do have some opportunities and some ability to sort of extract more firepower out of the existing portfolio. But absolutely, if we didn't think that, we wouldn't be coming to market.
Yeah, sure. And the speed at which you deployed the initial capital was what helped with bringing the dividend target up ahead of the initial target as well.
Yeah, that's right. That's right. There's a big difference between 4 months and 12 months to invest most of the capital, right? And that's allowed us to exceed expectations, our own expectations, and also, what we'd communicated to people who participated in the IPO. So, we really hope people are happy with that.
Yeah. Okay. Thank you. And question on where you are seeing the best pricing for renewables assets. Which sectors are you seeing the best pricing in, and has that changed significantly with the short-term pricing, energy prices?
Yeah, no, that's a good question. So I think we feel that the UK market is a very competitive market at the moment. So we're delighted with the solar assets that we own, and being able to acquire such a significant portfolio. We do see things like wind and hydro being priced quite differently in the Nordic region. It's one of the reasons why we also like the Nordics. And there is a bit of a spread. There is, and that difference, that better return that you can get in the Nordics, is, we think, really offsets or justifies you taking some risk on the foreign exchange rate, which you do when you buy these assets, because once you buy them in euros and then you receive a euro revenue stream. Now we hedge some of that euro revenue stream for about 5 years, but the bit beyond that, we do take risk on. But overall, we think that it more than justifies the return difference that's available at the moment. Significantly outweighs the risk that you're taking on with that increased exposure. Yeah.
Okay. Thank you. It's an interesting question on one of the projects you highlighted, actually, which was the distribution network. And the question being, is there more maintenance in a distribution network?
There probably is a bit more maintenance in a distribution network. Now, what's interesting about that and the way that these things work is that the more that you invest in improving the network and maintaining it and improving it, that adds to your regulated asset base. And the regulated asset base is what you get to charge your customers on. So to a certain extent, you are incentivized to maintain and upgrade that network by the regulator. So actually, maintenance in that sense is kind of a good thing. Now you don't want to overspend. That you won't necessarily get all of that back. But yes, you are, the way that the regulation is set up, it's good for you. The point about these things, though, if you want to think about it in the more medium term, is that when we invest in our solar parks and wind farms, at some point, they reach the end of their economic lives. That might be 30 years or 25 years or 40 years, but at some point they're worth zero. And in between, they yield out a yield, which is a genuine return, and they also return a bit of your principal back to you every year, a bit like a loan, right? If you buy a utility or a hydropower plant, in 30 years, that same time period, it's going to be worth more than it's worth today. So actually, your NAV, your NAV in your fund grows with that asset over time. Whereas with other more limited life assets like a solar park or wind farm, you have to reinvest a portion of the yield every year in order to maintain your NAV. And so we're one of the few funds on the market that has genuine, decent sized exposure to kind of perpetual assets like that, where the sort of profile, the risk profile, if you like, of that is very different from having to reinvest every year just to maintain the size of your fund. And that's another reason why we really like those kinds of assets. Not least of all because we don't have to go out and find new ones to buy every year just to maintain the NAV, right? We can just keep on investing in the ones that we have.
Yeah. Sure.
There's an interesting one here. Are we not too small to manage electricity grids? Well, that's the beauty of the Nordic region versus the versus the UK. In the UK, it's a highly consolidated market where utilities are very, very large. They're in the billions, and there's a handful of them. In the Nordic region, the grids on the scale of what we're talking about exist all over the Nordic region. They are still owned, but it's still very fragmented. They're still owned by local municipalities or small companies, and so yes, we're absolutely of a size where we can manage these smaller operations. The business that we're looking at the moment has a group of about 10 people, in an office in central Sweden who manage the whole business, and that's absolutely something of a scale that we feel very comfortable taking on and growing. Were there any other questions?
There's one up on here about the differentiation between your model and a traditional utility company, how it might differ, and whether you compete or partner with utility companies.
Well, on the last half of that question, we do both. So we're both a competitor in a very small way, compared to some of those guys. Some of those guys are pretty big, but we're perhaps a little bit more nimble than some of the utilities who perhaps have quite a lot of decision making to go through to do things, and perhaps want to do things on a scale that makes some of the things that we do unattractive for them. But how does it differ? I think if you think about a typical utility being a retail energy supplier, so somebody like an E.ON or a British Gas or someone like that, a Centrica, we don't supply individuals. So what we do is we own the generation, and then we sell our power typically to a utility company, who then buys that power from us and sells it to their retail or commercial customers. Now, where it starts to blur a little bit is the number of our assets have private wire arrangements that just connect them directly to a commercial customer, or in the case of our domestic rooftops, connect them directly to your house. My house, I've got some solar on the roof here, and I use the electricity first, and then the balance goes into the grid. So that's where we do overlap a bit. Now, some utilities also have dedicated renewable energy arms now, which just purely develop and construct and own renewable energy projects, which is a very similar business model to us. So there's overlap, but there are big differences.
Yeah, I understand. Thank you. A couple of questions really relating to what DORE represents in terms of overall assets within Downing in this area. So how basically just gauging how important the fund is overall within your renewables management.
Yeah. Well, the simple answer to that is really important. We launched this vehicle last year with the intention of growing this vehicle to be a vehicle that will be £1 billion in the future. And £1 billion in the future is a very, very significant portion of our assets under management. at the moment today, Downing has about 1.6 billion of assets under management, and this represents 122 of them. So it's a portion, but not the majority of our assets under management as a business. For my business, which is the energy and infrastructure business, it represents around about 20%. So a bit more meaningful for me. And I can tell you that we've really geared our operations up. We have formed an asset management business which spends an awful lot of its time. There are 20 people in that business, all on Downing's payroll, all looking after the assets in this portfolio alongside our other assets. And we formed that business a few years ago, exactly with this kind of initiative in mind, because we thought that it was important that we showed people that we did care, that we were different, that we wanted to go to the cost and the effort of forming that kind of asset management business, so that we could tell people that we were doing things a little bit differently. We were able to respond faster. We were able to analyze more data, not have someone in between us and the data, so we could make decisions more effectively, more quickly. And it is different. There are a few people like us that do that, but there are an awful lot that outsource that asset management function, and that is we think that just places you at arm's length from the assets a bit, and that's not what we're about.
And how do you allocate projects between different mandates within Downing then? Yeah,
so we essentially have two significant vehicles that we invest out of at the moment. They each have slightly different investment mandates, but there is some overlap. And when they do overlap, we have a committee that looks at the allocation of projects to vehicles. What we do is we look at the amount of capital they've got available, whether they've got any investment restrictions that would prevent them from doing a particular project or not, and then a variety of other different factors, and then we would make a decision and allocate the project one way or another, or if it was large enough, we'd allocate it but between both vehicles. And actually the nearshore wind farm in Sweden is a good example of that, where the project was of a size where it was a real benefit to have both investing, because it would have been too big for either one individually. But we thought it was a sufficiently attractive opportunity that we wanted to go after it and bring both vehicles into it.
Yeah. Right. Okay. And one other question's come in to clarify: do you take development risk, or do you get involved at a later stage?
Yeah, good question. So no, we don't take development risk. And what we define by development risk is investing, capital to pay for the development of projects. We will incur due diligence fees looking at a project that's in development to try and get it ready to build, but we'll only invest meaningful amounts of capital into it when it's ready to build.
I see. Thank you. Great. That's great. Thanks, Tom. I think we've covered all the questions off. Thanks very much for your time. As mentioned at the start and through the presentation, the fundraise is open until the 13th of October, which is this Wednesday. I believe it also is open on primary bid for individual investors, and you'll be able to look at that on primarybid.com website and for that as well. So I think at that point, thanks very much for your time this morning, Tom.
Yeah, thank you very much. And yes, just to point on that, it's just a thing with the platforms, unfortunately, with people like Hargreaves and people like Interactive Investor. If you hold your shares there like I do, unfortunately, they're not really set up for this kind of a placement. And so yeah, I think primary bid is the best way to go, and we've come to an arrangement with them to do that. So hopefully, if you are interested, please do look over there. If you do have any problems, then obviously do get in touch with Downing, and there are some contact details as well, and we can help you navigate that if needed. But thank you very much, Dave. Thanks very much for having us on again. I hope you guys enjoyed the presentation.
Cheers. Thank you. And thanks to all of our participants for viewing this morning.